Guys, what up? It's January 12th, and welcome to Q4 2022 earnings season. Now that we're done with the craziness of CES here in Las Vegas in the early part of January, we can focus on what we do on this channel, which is talk about stocks, earnings, news, and everything to do with what the market is doing, okay? So before we get started, hit that like button, hit subscribe. Hopefully you learn something from these videos and we have some fun in the meantime, okay? So let's get to business. So as usual, let's go over the numbers. So we got the Dow Jones up 0.6% to 34,189. S&P up 0.3%, not a lot, but almost kissing that $4,000 level, or 4,000 level rather, at 3,983. So not too long ago, this was in the low 3,800s. It's gone up significantly since then. So good move on the S&P. We'll talk a little bit about the valuation of the S&P in a minute when we're talking about earnings. Now the Nasdaq up also 0.6%, matching the Dow. And of course, not too long ago, this was in the low 10s, right? And dipping under 10 last year for a little bit. Okay, so the Nasdaq, of course, the hardest hit index this year because it's tech. Tech is high multiple, and high multiple stocks get killed when bond rates move higher. We'll talk about it in a second, okay? Now, the Russell 2K, 1,876, outperforming on the day by 1.75%. Amazing outperformance on the day. These are your small cap value names doing better than everything else out there. Okay, now the VIX, 1883, under 20, incredible under the current circumstances that we're in. Incredible that this is what the VIX is showing. Okay, I believe the VIX should be higher. It's not. The market is saying, hey, we know what's coming. Things are baked in. Prices are baked in. Positivity is creeping back in. So it's going to head lower, of course. Okay, now the US 10-year, 3.46 as of probably, 10 days ago when I did my last market breakdown, 3.84 on that 10-year. So you see a big difference here, right? Heading lower. And this is what allows these guys to flourish, right? As bond rates go down, stocks get more enticing. As they go higher, stocks get less enticing because of that yield, okay? Now we're talking about energy. Pretty much the same on WTI, Brent. That's your European oil index. And the big story is natural gas. Okay, natural gas 3.67. Incredible cliff dive on the price of natural gas. I mean, incredible. Last time we spoke 10 days ago, 412. Insane moves to the downside on natural gas. This is bad for all these energy stocks like a Coterra, like a Cheniere, like a Linde. These guys that sell natural gas, they produce liquid natural gas and export it to Europe. Good for Europe. They're not buying gas as expensive because they're able to get enough supply, and the winter there has been warmer than expected. So really good for them. Causes that drop in the price of liquid natural gas shown there. Okay, now when it comes to this spot here, or I added this spot here because I thought it was important to kind of track this as well when we're tracking markets, which is the price of the dollar or the strength of the USD, the US dollar, 102.40. Okay, and if we pull up a chart, I don't think there's a need to pull up a chart, but it's been in a nosedive also. Okay, this at its highs was around 120 as far as the strength of the dollar, and this is important to help measure the possible profitability of companies reporting and stocks. The stocks of companies that do business overseas, that they need to take their profits they make overseas and repatriate those profits into US dollars. The lower this is, the more profit they can show you on their quarterly statement. So we need this number as low as possible. Okay, and that's why it's important to track there. Now, when it comes to what I'm focusing on this video, we're talking stonks, and I think you'll get what I mean by that when I go to the next slide. Inflation, the Federal Reserve, as usual, great. The soft landing economy sort of theory and how that's working out. And, of course, earnings season. Okay, so let's move on. Now, we're talking about market positivity in stonks, right? And stonks, when I talk about stonks, I think you know what I'm talking about, guys, right? And I'm not going to mention any names, but I think you know what I'm referring to, right? So we see these stocks here, and the group of folks that invest in these stocks are causing gigantic daily moves on today, right? We see GameStop up 8% on the day, AMC almost up 10%, Bed Bath & Beyond at 50% on the day, Carvana, I mean, I can't think of a worst or a business that's in the worst place imaginable to contend with higher rates and a slowdown in the car business. Not only a slowdown in the car business, a decline in the Manheim used car index, like we haven't seen in a long time. And what I mean is a decline in the price of used vehicles. And in the CPI read, used vehicles was like one of the things that was negative in CPI. So we know for sure that used car prices are declining rapidly, right? 46% positive on the day. I mean, guys, I don't know. I don't know even if you can make this up. This is stuff of just lunacy sometimes, okay? But it's happening. It's positivity, not the best kind of positivity, but it's happening. We just deal with it as it comes. I don't touch any of these stocks. If you do, more power to you, okay? Now, everybody's favorite subject, the Federal Reserve. Okay, so the Fed's still not your friend. We know that, okay? Fed funds rate at 4.25 to 4.5, not including quantitative tightening. Again, if you take in quantitative tightening, you have a lot of experts saying, hey, this rate here is really close to 5%, maybe a little bit higher, 5.1% as far as the Fed funds rate, if you take into account quantitative tightening. If you guys have any questions about what that is, let me know, or just look it up. Pretty easy stuff to look up, okay? Now, the question is here, pause or pivot in the market expectation of 2 more hikes in 2023 of 25 basis points, and then stop and assess, okay? And hopefully they become data dependent, maybe based on what CPI and PPI have to show us for the rest of the year. And in case you don't believe me about the market expectation, I'll bring this here, okay? This is on Twitter, CNBC Overtime, asking about the expectation of rate hikes this year. We're talking about 2 rate hikes, 43% of voters here, 1,500 votes saying, hey, the expectation is 2 more rate hikes. So that's pretty reasonably in line with the market expectation, okay? Now, demand destruction is the name of the game still with the Federal Reserve. There's no pivot yet. They're still trying to destroy demand in order to reach price stability. That is their mandate, okay? Now, these are questions here that I've kind of heard recently from several folks and over the news that I kind of want to go over. And the first one is jawboning, okay? Jawboning, pretty easily described, okay? It is talking tough and not following through as tough as what you're saying, okay? So the Fed is putting this front of toughness, of hawkishness, of restrictive rates, of being a Volcker type chairman for Jerome Powell, as far as Jerome Powell is saying. And jawboning is when they don't follow through as tough as they're talking. So that is what they've been doing, or that is what the market believes they've been doing. Of course, nobody has a crystal ball, so we don't know for sure if they're jawboning, but the market's going higher like this, the bond rate's going lower, are telling the Fed, we do not believe you, and you're jawboning us. So that's what that means. Okay, now, has the Fed already gone too far? That's another question. And what is the damage that the Federal Reserve has caused? When I think about the damage, I think about housing. I think about stocks like Home Depot, Lowe's, more than anything. I also think about stocks like credit cards, American Express, Capital One, as far as the debt levels that Americans have been taking on in credit cards, and whether loan losses are going to start to ensue in those companies. We're going to hear the banks report starting tomorrow. Be very interesting to hear what they're reporting as far as loan losses above, at, or below expectations. Now, I'll move to the next slide here, and I know if you guys are like, no, go back to the Fed. No, I know you don't want to hear about the Fed, okay? So I'm getting over quickly the Fed this time, okay? We're talking about CPI. That's something positive that happened today that is cool to talk about, okay? CPI, Consumer Price Index, came in today as expected, in line, okay, which is good, not great, okay? The month-over-month read was negative for the first time in forever, okay? In 50,000 years, it came in negative. That is good. Not great, but good. Okay, and the year-over-year read, 6.5 and 5.7 without taking into consideration food and energy costs, which energy costs are lower. So I would think that this number maybe probably a little bit lower than it should be. Okay, now I'm going over these points, okay, one by one. Undeniable that inflation peaked in June of 2022. Undeniable, okay? And the CPI has given us this Goldilocks or possible Goldilocks number when it comes to the soft landing scenario for the economy, okay? And I'll go over that in a minute and kind of explain all that, okay? So when we're talking about the CPI, came in line on an annualized 3-month basis. It shows that it's cooling as expected, that inflation is trending the right way. There's no disputing that, okay? And with the earnings cliff, and we'll talk about the earnings cliff, is what analysts are saying about earnings in Q1 and Q2 of 2023. They're saying earnings are going to drop off a cliff. That still hasn't happened. That's just analysts talking. And if it doesn't materialize, what does that mean? Soft landing, okay? If everything keeps going the plan as it's going here, okay? Now, with the Fed, we're talking about the Fed not needing to go as far with rate hikes if all these things keep working out as expected and if this stays true. Now, we talked about job owning, okay? So the Fed job owning, and if it turns out that they are job owning, that's positive for the markets, and the effectiveness of rates are working, meaning the job of the Federal Reserve and what they set out to do to destroy inflation through demand destruction did work. Okay, now job market still robust. So you hear a lot about Facebook laying off tens of thousands of people, Amazon, who else? I don't know if Apple did that, but you know what I mean. Tech companies laying off folks is happening. However, the job market is still, it doesn't affect the job market at all. It doesn't tick the unemployment rate higher as much as you would want. I was reading a report that tech jobs are not even 2% of the overall job market. So all these layoffs that we're hearing from the tech sector don't really make a dent in the unemployment number, meaning that the job market is still robust and we can absorb those job losses in the economy because there's still so many job openings available out there. Okay, now this is a little bit hand in hand, but Europe evades the emergency crisis looking like it. Like we said in the beginning, hotter summers, right? And the price of natural gas being cheap, right? The Ukraine-Russia war not going the way that everybody expected it at or to go at the beginning, okay? And then the earnings disaster. We just talked about that stuff, okay? But also China reopened, man, and This has a little bit of a sore point for me because of Wynn Resorts, right? We own Wynn Resorts. We switched it for Disney. Disney is now in this proxy debacle, which has caused the stock to go higher. Thank you, Lord. But at the end of the day, we made a switch from Wynn to Disney because we thought China will not reopen. I was so sour on China, so negative on China that I just got it completely wrong on Wynn Resorts. Now it's almost $100 stock when we owned it in the low 70s, and we would have made some money there, and hopefully maybe they would have reinstated their dividend because of Macau coming back online, okay? But at the end of the day, I still have some reservations about Chinese stocks, but the China reopen, nothing to do with that. It improves the supply chain. That's what it does, right? It improves the supply chain. It makes more things come to the U.S. via their ships, via their supply lines. And with the stabilized energy markets, it all points to a soft landing situation, meaning that the Federal Reserve can start to pivot and the damage to the economy is not as extreme or is not as extreme as expected, okay? And the question that would remain is, what did the Fed break? And if it's close to nothing, that means soft landing is achieved. So right there, the soft landing sort of theory in a nutshell. All right, so what's left? And what's left after a soft landing scenario works are earnings, okay? And earnings are what move stocks, guys, right? Not what happens in China, Europe, the price of energy. That doesn't really move stocks the way that earnings move stocks. That's what causes our multiples to expand, to contract. So that's what we're looking at in this coming week, starting tomorrow, earnings. And this is the calendar so far that we have. So it's not a very full calendar for earnings because earnings season technically starts right here on Friday with Bank of America. We got Citi, BlackRock, and I think JP Morgan. Yeah, JP Morgan right here reporting earnings. So, of course, we want to hear those conference calls, okay, and look at their earnings report to see what these guys are reporting. I'm very positive on getting a good read of the economy from Bank of America and JP Morgan. Not as much JP Morgan because I feel like Jamie Dimon has been very negative and wrong lately in his takes. I think Bank of America probably has the best take on the economy that you will get. So even if you don't own stocks, or even if you don't own a bank stock, listening to the conference call of Bank of America is going to be very helpful to you as a shareholder. Okay, of course, we already had KB Home and Taiwan Semi. I kind of browsed over those. I really want to listen to Taiwan Semi and what they got to say. I know that they guided down, but the stock went higher after they reported, so I want to really see what caused the stock to go higher after their conference call. Okay, of course, we're watching for EPS, revenue, guidance, or positive outlook. Okay, and the reason I'm writing positive outlook is because I think that's what happened with Taiwan Semi in the limited amount of things that I saw, is that their guidance was lowered, but they were positive on the overall year 2023 towards the end. So giving that positive outlook caused the stock to go higher. And of course, margins. What are happening to your company's margins, the profit margins, gross margins, and how are those being affected? Are they expanding or are they contracting? Okay, now what I want you to consider before I end this video is I want you to consider the forward PE of the S&P 500 at about 18 and 19 times earnings. So the S&P 500 collectively has a forward ratio of about 18 to 19 times earnings. What I want you to understand is if the company that's reporting that you own sits above this ratio, the forward earnings I'm talking about, you need to know that you're on the chopping block unless your stock has already been severely beat up. You don't want stocks running up on earnings. You don't want CEOs saying our margins are bad, our outlook is negative, okay, when stocks have been running up against that, because you're going to get clobbered if your stock sits at a forward earnings of above 18 to 19 times. I'm looking at you, Tesla. That's what I'm looking at, okay? And then I also want you to consider the damage already taken by the stock you own, okay? But if it sits under that 18, 19 times earnings, you have a little bit more leeway to get it wrong, okay? Now, or to have a not as bad as feared sort of quarter, all right? Now, please let me know if you guys have any questions about any of this stuff. I know that I went over a lot, but I'm trying to kind of compact these videos as much as I can and be as helpful to you as I can. Please let me know on the comments. Reach out to me on Instagram, Twitter with any of your questions. I'll be happy to help you. Like, subscribe. Peace out.